This year's budget is fiscally disciplined, deficit is falling, debt metrics are improving, and yet the bond yields didn't rally. And that contradiction is exactly what I call the bond paradox. That is what we are going to discuss today. So here's the paradox in one simple line. Fiscal discipline does not necessarily mean lower yields. Markets don't trade speeches, they trade demand, supply, and the credibility that the particular nation has. This budget came at a time when global interest rates are still high, liquidity is tight, and the capital is extremely selective. In such an environment, bond markets don't want stimulus, they want predictability, and that context is very critical to understand the bond market reaction. To the government's credit, macro assumptions are still conservative. Nominal GDP is expected at around 10%. Real GDP is expected at around 7.2 to 7.8%. That reduces the chance of revenue overestimation and lowers the risk of fiscal slippages. For the bond markets, that's a positive starting point. Now, let's talk about fiscal discipline. Fiscal deficit for FY27 is expected at around 4.3%, lower than last year's 4.4%. That is not aggressive consolidation, I understand, but that is consistency. For the bond markets, consistency matters more than the speed of consolidation. So, if fiscal discipline is intact, why are the bond yields still uncomfortable? The answer lies not in intent, but in supply. Gross market borrowing for financial year 27 is projected at 17.2 lakh crore rupees, whereas the market was expecting something closer to 16.5 lakh crore. The gap is the heart of the bond market reaction. The higher borrowing is not driven by government overspending, but it's largely driven by redemptions. For financial year 27, the redemptions are close to 5.5 lakh crores. So even if the net borrowing amount looks reasonable, the supply entering the market is still very high. And this is where the bond market math comes in. When supply of bonds increase, the demand does not rise substantially. And this is why the yields have to adjust upwards for the supply to clear. This has nothing to do with fear or panic, but generally how the bond market functions. On the revenue side, tax collections are expected to increase by 7% year on year. Growth is led by income tax and corporate tax, whereas the GST collections landed a bit softly because of the earlier tax rationalization. These numbers are realistic, not stretched. One supporting factor in the budget is higher RBI dividend. Dividend from RBI and other financial institutions is expected to be at around 3.1 lakh crore rupees. This comes from foreign exchange income and interest on foreign assets. This helps but does not eliminate the supply pressures. On the expenditure side, total spending as a percentage of GDP has actually declined. Revenue expenditure is lower, while capital expenditure is expected to be steady at around 3.1% of the GDP. The expenditure mainly focuses on railways, roads, defense, and telecom. This is stability, but no fresh capex exposure. Now, let's talk about what the markets were hoping for but didn't get. First, there was no change in fixed income taxation. Second, there was no favorable change in FPI taxation for equities. In the year of heavy bond supply, these could have helped demand at the margin. So, how should we read this budget? This budget is not bond bullish budget, but it is also not fiscally reckless. The correct interpretation is this: near-term bond market remain cautious because the supply is heavy, not because credibility is broken. If you track interest rate, bond yields, and RBI policy, this budget tells you one thing clearly: fiscal discipline is intact, but supply will dominate the price action. If this breakdown helped you, like the video, subscribe, and let me know if you want to follow up on the yield curve strategy after the budget.